So continuing on with the concept of Subpart F and the foreign personal holding company rules and foreign personal holding company income rules, what I want to do is give an example that highlights some common misunderstandings about planning dealing with intangible property. And I'm going to just give an example, and we'll talk through some of the issues, and then I'll also highlight some of the items that we're not going to discuss on this video, but we can discuss later. So if I start with a U.S. company, by the way, the U.S. company could also be a U.S. individual, but a U.S. company, and it wants to quote-unquote offshore part of its business. It turns around and sets up, its tax haven, its tax haven company. We'll call it tax haven. And we'll say this is in the Caymans. Caymans is nice because it's got zero tax and zero treaties, and it seems to be the country of choice for many. So what the planning works, and this is specifically to, again, intangible property. What the planning is that the U.S. company somehow migrates the intangible property offshore. And what I mean by somehow migrates the intangible property offshore is there are a couple of issues here. One, there are some general rules under Section 1001 which say that if I sell or exchange intangible property for stock, that it's taxable. This is the general rule. This deals with anything that involves a sale, exchange, or other disposition of an asset. There's an exception to 1001 dealing specifically with 351. That's Section 351. And again, this is something that most tax practitioners at least are aware of. And that is if I contribute assets to a company in exchange for its stock, generally speaking, I can get tax deferral on that. But when we're dealing with a foreign company, again, this is foreign company, there's an override to that rule that deals with outbound transfers of assets, even in something that would otherwise qualify as 351 when the recipient or the transferee is a foreign company, and that's going to be Section 367. And then within 367 there's some additional exceptions that get you back to tax-free, but when it comes to intangibles there's a Section 367D. 367D specifically addresses the outbound transfer of intangibles, and basically when you hear on the news or elsewhere about companies expatriating or doing some type of mobile intangible property scheme, this is the area that they fight with the most. This is the area that creates the most issues. And again, the idea here being is this is generally a taxable event. So for the time being, let's go ahead and assume that somehow we've navigated the 367D rules and we've gotten this intangible asset offshore. Once it's offshore, I do have another series of tax issues, which we've covered actually in a prior video, and this has to do with Section 956. 956, if you recall, deals with investments in U.S. property. Investments in U.S. property, I think in the video we talked mostly about tangible property, but it turns out that you can also invest in intangible property offshore, and if that intangible property that is held here is used within the U.S., then what happens is that's considered an investment in U.S. property, and potentially, depending on how the transaction was structured, that could give way to a deemed dividend and a taxable event. We're going to assume that we've also cleared that hurdle. So we're saying green light here, we fix this. Green light here, we fix this. So now what we need to do is, now that the asset's offshore, we need to talk about how the asset gets used. And predominantly the way an asset gets used is it's going to be licensed, and then there's going to be a royalty paid back. So the U.S. is going to use the intangible, and in exchange for the use of the intangible, there will be paid a royalty. Now, if you recall back to the general rules for foreign personal holding company income, we talked about dividend, interest, rents, and royalties being a certain class of income that would give rise to foreign personal holding company income. which is Subpart F, and we talked about there are some exceptions for royalties, but what the exception doesn't apply to is related party. So in this case, we have a related party royalty that's being paid from the Cayman company back to the U.S. Well, this payment that's coming from the U.S. to the Cayman company is going to generate the royalty income of the Caymans, and that ultimately now is subject to these foreign personal holding company rules. Now, in many instances, this may or may not be an issue, and it may or may not have been structured in such a way as to provide any benefit, because this is the Caymans, there's no treaty, so one of the issues we do have here is under the withholding rules, and potentially what you end up with is a withholding liability. And if you have a withholding, let's see, withholding, if you have a withholding liability, what you can end up with is paying tax on it anyway. But again, let's assume that I have navigated through the withholding as well, so I have no tax on getting the asset out. I have no investment in U.S. property, no withholding. In fact, I guess what I could say is maybe the intangible is not even U.S. Maybe it's just a foreign intangible. Foreign intangible should be able to circumvent both of these rules. I still have the issue of it being passive income in the U.S. Now, the way the strategy normally works, let me clear the screen here. The way the strategy normally works, again, is I have somebody here in the U.S., they have their foreign company, and what they're doing is they make the payments down, and the payments stay in the foreign company for a lengthy period of time. And the belief is that by leaving the payments in the foreign company, there's no tax because I have not paid a dividend. So dividend, no. Okay, this is an actual dividend. But what has happened is the royalty, because it is foreign personal holding company income, it becomes what's called a deemed dividend. Deemed dividend. And as a deemed dividend, it is subject to tax. Deemed dividend. So at the end of the day, even though I may be able to funnel cash offshore to this foreign subsidiary, I'm subject to these deemed dividend rules where this thing still is going to pay U.S. tax, effectively defeating the believed tax benefit. Having said that, there are ways to make this work, but it has to be done in such a way as to meet the requirements of the anti-deferral rules, which are laid out very clearly, or I'll say in the most part fairly clearly, and you can navigate those and eventually potentially get to a point where you are not subject to the anti-deferral rules and you do get deferral. But I guess if I kind of scroll back here, we'll probably need to cover on another video. Whoops. We'll need to cover on another video the issues of 1001 and what this means on outbound transfers of intangibles, and we'll probably need to spend some time on another video with withholding just to cover that. So anyway, thank you for spending a couple minutes, and we'll see you next time.